Welcome, everybody. Thanks for joining us. I am Drew Schiller. I'm the co-founder and CEO at Validic. Thanks for coming to our panel on the future of funding. In addition to being the CEO of Validic, which is a digital health company that brings personal health data from digital health apps, wearables, in-home health devices into the healthcare system, I'm also on the health division board of CTA, Consumer Technology Association, which puts on CES, as well as the board of industry leaders. So really appreciate you all coming today. And just to kind of set the table, digital health funding went through a wild cycle over the last couple of years. And that's what we're really here to talk about today, is to talk about, what's gonna happen in the future, right? We saw startups go through a really challenging cycle of down sales. We saw a lot of valuation crunches. We saw a lot of down rounds. What's gonna happen in the future? And our panelists here are gonna help tell us what's gonna happen in the future. And in this panel, I've talked to my team here, and we have agreed to make this a little fun and engaging, and we are going to say the quiet parts out loud. And so what I mean by that is I was in a conversation the other day, and somebody said, the healthcare system's broken, we need to fix it. And I said, listen, I actually disagree with that. The healthcare system's not broken. It's working exactly as it's intended. It might not work very well for you and me, but it certainly works very well for the people at the top and for the people who are perpetuating it. And that's the real challenge that we have to solve. And Renee Quashie said to me, who's head of digital health at CTA, said to me, whoa, that's something you wouldn't say on stage. And I said, I bet you I will. So that's what we're gonna do today in our introductions. I'm gonna ask my panelists each to introduce themselves, very quick name, rank, serial number, what they do in digital health very quickly, and then what is the unsaid thing that they are solving that maybe they wouldn't normally say in their introduction. So Megan, I'm gonna start with you.
Challenge accepted, I guess. Thanks for having me. This is super fun. I'm Megan Zweig. I'm the president and CEO of Rock Health Advisory. We exist to support enterprises with their digital health innovation strategies. Other parts of Rock Health, we have a venture funds. We're doing early investing. We also have rockhealth.org, which is our nonprofit really focused on making sure that innovation and technology are closing equity gaps as opposed to exacerbating them. We were founded back in 2010, and I think at that time there was a ton of skepticism about digital health. And so I think the unsaid thing was, how do we even start to create this market? How do we even start to convince key stakeholders in health systems and health plans and life sciences companies that, I think what was thought of as the Silicon Valley bros, have something to bring to the table, that software is eating the world, and yes, it's going to eat healthcare as well. And I think we decided to exist because we needed to bridge those worlds and figure out where collaboration made sense. Fast forward to today, I think we now exist really because there's still so much friction that exists between incumbents and between emerging players, small players, big players, and there's a lot that goes unsaid in terms of how are the cultures different, how are the capabilities different, how are the incentives really different, and that's gonna impact success. And so I think we really exist to help be a translator between all of these pieces and really always look at things from the perspective of the consumer, the patient, incentives aside, what is the world that we are trying to build towards, and how do we get there?
And dude, by incentives, you mean if it doesn't make ROI in plan year, it ain't getting funded.
Hi, Ben Schlock. I'm a partner in Material Impact Fund. We're a Boston-based venture capital fund with approximately $800 million under management. I'm proud to say before I joined that team, I was an entrepreneur. I'm up here with a lot of CEOs and leaders of great healthcare organizations. I led a digital health company for 12 years through an acquisition, and then spent 2 years at the acquirer, so I got to see the other side of what that journey looked like. I think one of the unstated, well, it's part of our mandate, but as it relates to material science innovation in the tough tech ecosystem, we really focus on underrepresented health. So that could be access, that could be diagnostics, that could be care, often through the combination of breakthrough devices that leverage some sort of material science along with analytics. And I'm proud to say that one of our portfolio companies, and by extension teammates, is up here on stage, Alicia, so I'll pass it to you.
Thank you. Hi, everyone. I'm Alicia. I'm the founder and CEO at Bloomertech. Our company is focused on heart disease in women, which is the leading cause of death and disability worldwide. And today it is harder to recognize, diagnose, and treat in women. We've created a wearable bra that collects data all around the torso in a medical grade way. We call it a textile sensor intelligence, and we can inform cardiologists and patients about her heart, her lungs, her hormones, and her metabolism, right? So we're taking healthcare all the way over to the unspoken thing, which is the huge problem in the healthcare system of most of our system is designed around male physiology. It's not doing the work that it needs to diagnose women properly so that they can get the right intervention. It is 7 times harder to diagnose a woman today with heart disease. So this is a huge problem, and I think when we look at the true unspoken things is the value that it creates to do female-specific solutions. Just last year, Shockwave Medical, which got a huge, I think one of the largest acquisitions, if not the largest, they are the only ones that have done a female-only study of their technology, which is for an intervention to the heart, right? So the value of doing this is highly significant, and we're not looking at these industries how we should because of the potential of these untapped opportunities because we haven't served populations that are different for a long time.
Yeah, I love that. Thanks, Alicia. I mean, men's health has certainly served me well, but it hasn't served the rest of the other half of the population, right? And I think that's exactly what needs to happen. Okay, so to start us off, Ben. So I've been talking to some friends of mine who are in VC, in fact, one who recently switched VCs because the VC he was at raised a fund in 2018, and now for the life of them, because they've been unable to return capital because of the market downturn in digital health, they cannot raise their next fund. They have no idea when they're gonna be able to close their next fund. And you know, I'm seeing this as a real trend, and so I'm just curious, you know, do we expect there to be less investor capital in general, like in digital health specifically, but maybe more in general? What are you seeing in that?
Well, I'm going to defer to my esteemed panelists for some of the statistics because Megan is closely focused on this issue, but I can definitely touch on the macro point of view. If I look over the last 2 years, obviously venture capital funding has come down significantly. If you look at new first-time fund starts, some of the lowest in years. If capital is being deployed, it's being deployed towards the top 10% of money managers who tend to have very large funds and who tend to have very mature companies that are staying private longer because the IPO window is closed. That money that's getting deployed there is definitely coming at the expense of new, exciting startups. So that's the cynical moment we're in. I think Megan might have some perspectives on where we may be headed on that topic. But that said, you know, I will just use our firm as an example. We announced our third fund at the end of 2023. So, you know, there was an example of first time, second time, third time fund. It was our largest fund, so definitely some momentum there. Dimension Partners just announced a $500 million crossover fund between biology and technology focused on life science tools. So I think for the right theses and the right teams, capital is still getting deployed to newer money managers. I think also I see in the seed and A round deals the newest of new capital still being deployed to innovative companies. There is still this view, though, that particularly in the digital health sector, if you raised a lot of capital and you got to a spot where your valuation was high and you hadn't quite proved out your business model, you hadn't shown a path to profitability, that's a really difficult spot for those companies to be in. Many companies, though, led by experienced entrepreneurs, tacked into the wind and readjusted their operations very quickly, and I think those companies will come out the other side. I think about it a little bit like my grandmother that grew up in the Depression and made it to 93, walked 2 miles a day, and could beat me in arm wrestling until I was 30. Some of that was genetics, but I think it was a lot of the environment she grew up in, and I think the best companies come out of those environments.
Yeah, you know, it's a really good point, and I'm thinking that maybe underpinning what you said, I'm just curious if you could validate this or not, maybe it's the first time funds where their first fund was raised in 2018. They don't have an operational history. They haven't had the exits. Maybe they're the ones who are struggling more.
I don't have primary data on it because it doesn't apply.
I'm asking
to us.
for your gut.
Yeah, but I get the sense that if you've been out in the market for a really long time and have a great track record and you're large, it's easier for sure. And if you're a newer fund, you definitely have a differentiated point of view. You have to have a great portfolio that LPs are excited about as you start to raise subsequent funds. But let's ask the expert.
No, I'll go. What I'll add to that is when we look cross industries, so not just in healthcare, there's incredible capital concentration among what are now deemed mega funds. So those funds that have at least $500 million to deploy. I think it was PitchBook. They reported that over 2024, it was something like 9 funds raised 50% of all capital from LPs. Just looking at General Catalyst and Andreessen Horowitz, they raised 20% between the two of them of all capital raised by venture funds. So that is not we have not seen that degree of capital concentration in the past. GC and Andreessen also are huge investors in digital health, according to our tracking. They had the most deals last year in terms of any VCs. I think it was something like 14 deals plus each. And so I do think that, to your point, there has to be true differentiation among the smaller funds in terms of what that value add is. I think the big funds, I mean, they're huge power, huge networks, huge expertise, but they also really can tip the scale when it comes to terms and when it comes to the trajectory of the company.
Agree with that.
Yeah, all right. So let's expand on that a little bit more. I was telling you just before this that I heard this week from a VC that is they have a digital health practice, and they are now only investing in companies that are outside of the traditional healthcare system, which kind of blew my mind when this is like the largest part of the economy of the largest economy in the history of the world. And then they're trying to invest in companies that are outside. And I think you made a really good point, which I hope you'll make again around that. But what are some of the trends that you're seeing outside of my anecdotal surprise there with Rock Health?
Yeah. So we track venture funding every year. We're looking at funding that's flowing into US-based digital health startups. Our next report is going to be published on Monday, so it can give you a little bit of a sneak peek on that. When we look at 2024, we saw about $10 billion that was invested in these US-based digital health companies. That's actually pretty similar to what we saw the year prior. It is much lower than what we saw in those peak years of 21, 22, where we saw it was something like, I think it was over $20 billion invested into the space. I think what's interesting, though, is when you look at the numbers compared to 2019, so using that as kind of like the pre-COVID benchmark year, the dollars that were invested this past year, if you look at it inflation adjusted, were essentially the same as what was invested in 2019. So we're almost kind of back into this pre-pandemic funding level. Couple interesting dynamics, though. One is that we saw more funding last year flowing into early stage companies. So in 21, 22, there was so much capital available. You had a ton of these mega deals, these deals over $100 million. You saw the volume of those deals really shrink over the past year. So that brought funding numbers down, and you saw more investment going into these earlier stage companies, I think, who don't quite have those valuation hangovers relative to the companies that raised at really high valuations in 21, 22. So a little bit of a dichotomy of, yes, still a ton of momentum and investment going into those early stage companies, but at the same time, you have capital concentration among venture funds. And also we can get to this later, but I think that there's also a lot that's happening in the market that is creating, I'll just say, more power, more influence among like the Goliaths of the healthcare industry. When you think about who's building foundational AI models, who's even building a lot of those application layers on top, it is the big tech companies. It is the most well-funded startups that we see in the space. Part of that is driven by enterprise demand. They don't want point solutions. They want something that's going to be able to integrate across all of their AI use cases. So you see the Commures of the world, the Abridges of the world filling that need. And so I think there's this interesting dichotomy right now of, yes, investors are still really excited about early stage innovation, but when you look at some of the big plays that happened this past year of the big pharma companies going direct to consumer for the first time with Pfizer for All, with Lilly Direct, when you look at just the big tech companies and all the plays that they are making with Cerner, with Epic on the AI front, a lot of the big moves that we're seeing are really coming from those big players.
Yeah, that's really great. And, Alicia, I'd love to, you and I are kind of like living through this together, man, this like roller coaster ride over the last, 4, 5, 6 years, et cetera. I mean, I've been doing this for a long time, but it's been pretty wild to see like what happened 2020, 21, 22, and then like, whoa, just like bottom dropped out, right? And now we're seeing the return, and Megan just mentioned a couple companies. I won't, if you guys remember who they are. I'm not gonna say them again, but I'll just say like 100x revenue valuations. So we're seeing the return of some of these mega valuations now, and I'm curious, like, as a startup founder, as a CEO, as you're navigating this, like, how do you think about steering the company through these like peaks and valleys of valuations and capital funding?
Yes, thank you. I think one of the things that we've seen throughout this roller coaster, as you call it, we've seen companies raise a ton of money and those rise and falls, and people trying to figure out that sustainable growth strategy. For us, we were very clear since our inception that we wanted to grow with the company. And I think one of the things that hit me very hard at the very beginning was when my co-founder, we both met at MIT, told me at the very beginning, hey, we can't continue not sleeping and doing like we're running a marathon, being like we're running a sprint instead of a marathon, right? Like we need to be more sustainable if we want to take this for the long run, because we chose to be in deep tech, we chose to be in women's health, which for a long time has been severely underfunded for hundreds of years, and we chose to build a physical regulated product, right? We wanted to validate something clinical with clinical quality. So this was not going to happen overnight. We needed time to collect the right data. We needed time to ensure that we create the value that we need. So for us, it was about getting the right partners at the right time so that we could deliver what we envision our company is going to become and how we're going to transform healthcare. So we went into finding the right partners, which means they have experience in cardiology and they have experience taking technology out of the lab. And we did this, and to give you a little bit of the glance, right? Like we met at MIT, we were part of MIT's Computational Cardiovascular Research Group and a program called Integrated Design and Management, which focuses on product design and development. And in 2017, we realized we should incorporate because this is a huge opportunity, like the market is untapped. But we graduated in 2018. And when we graduated, we focused on early feasibility studies, all of this with non-dilutive funding. 2020, we raised our first round, our seed round. We closed it in February. What happened in March? The pandemic. And bear in mind, we were building a physical product, right? And then all of these roller coasters that you're talking about started to happen, and we saw companies rise and fall, rise and fall. So I've kept in mind what my co-founder said. This is a marathon. We need to build sustainable growth. We need to be laser focused on the type of company we need to build. And I think that's how we've been able to go through these cycles and seeing everything that's happening and being mindful of getting the right partnerships, ensuring that we meet the ecosystem that we're building, because we could use our sensor technology for different applications. We've chosen this area because we see huge trends and opportunities here. And just last year was announced that the femtech industry is worth $1.5 trillion, and heart disease is the largest challenge in those trends. So we do believe we're on the right track there.
Go Bloomer. I'll just comment on what Alicia said from an investor perspective, because she's powerful, but she's humble. This team is the definition of how to operate a lean, scrappy, aggressive startup while appreciating it's a marathon. I mean, the things that this team gets done with the resources that they have, given the environment, is best of breed. And I think, that's a really tough choice if you have access to capital to make the choice that I'm going to build the company in a very determinate way that is going to grow with the milestones that I hit. And a lot of companies don't do that. A lot of CEOs don't do that. I think Alicia definitely stands out from the crowd in that regard, and so does Bloomer.
Yeah, that's awesome. There's we've all heard the phrase unicorn, right? Which is a startup with $1 billion plus valuation, which Arlene Chung coined that phrase like 15 years ago in an article, intending it to say a unicorn is something you don't see. And then it became like
a goal. It became a goal.
It became a goal to become a unicorn. I had a really funny conversation with her about that. She was somewhat regretful about creating that goal. But the counterpart to a unicorn company that I think you're talking about with Alicia is called a zebra, right? And a zebra is a company that is able to live within its own means, build within itself, build an actual real company. And so I really appreciate that. Alicia, one tag on that I'll ask you about is that one of the things that drove me most nuts, and fortunately it didn't impact Validic too much because we've been very thoughtful like you about how we take capital and deploy it. But this was really, really something that I saw with a lot of my friends who had raised big rounds, is that in 2021 and early 22, everything was about growth. And it was like your cash graph, and it's like, oh, well, when you get to here, we just raised more money. But as long as there was growth, right? And what that meant was that we could use venture capital to subsidize the cost of our product for the health system. The healthcare system was extremely stretched thin. Health systems especially weren't able to afford things, so there were free pilots. There were, you were selling things for whatever people could pay for it, which oftentimes was actually less than the cost of servicing the product. And that was all subsidized by venture capital. And then what happened was 2022, mid-22 hit into 23, venture capital evaporated. And now all of a sudden, you have a business model that just doesn't work in that environment, and you can't raise any more capital. And so that's why I think we saw so many companies squeeze. So I'm curious, Alicia, if you saw any of that, felt any of that, or like kind of what your perspective is.
Sure, I think we definitely saw a lot of that, especially how it hit people's payrolls, and you see the layoffs, and you see all of these things happening with many of the digital health companies that you either admire, looked up to, and you saw that they raised a lot of funding and that they were deploying and having a lot of engagement. And it seemed a lot like the tech bubble that happened even before that. So at the same time, right, like we're very into the evidence, and some of these companies also had this gray area of not having scientific papers published, of not having enough support for the outcomes that they were seeing. So some of the things that have vanished, you're actually kind of wanting more evidence. They spent so much money, how come? If you have
Are you
access,
saying they deserved it?
No, not. I wouldn't say that, but I think it's good examples of how you can learn from what you see, so that you can avoid some of those pitfalls. I think it's something that for a long time, because right, like the more money you take, the more you have to deliver in return at the same time. And if you raised a ton of money before having the value in your product because you haven't figured that value yet, you're not going to be able to sell it at the price point that you need to sell it to deliver the money back. So it goes hand in hand. You have to grow sustainably with your company to be able to sell and push it to the market when it has the right value, instead of like not having the evidence. We're talking about people's lives and people's health at the end of the day. Right? It's not just a tech product that will, you know what I mean.
Yeah, no, totally. I totally agree. And so Ben, I'm going to transition to you because, Alicia just said, the mega valuations, we're starting to come back to it. AI is like all the craze. And I'm curious, And you mentioned, Megan, a couple of those companies. I'm curious, how big of a role is AI playing in your investment thesis, and how do you even vet the companies and like what they claim are their technologies? Because it's brand new, a lot of it.
Yeah, I certainly can comment on that from our perspective, which by definition links the concept of AI to a physical product, which may be a little bit different than a pure play software company that's applying it to the healthcare system. So it's important. We have several investments where AI is critically featured in the business. I think if I think about healthcare broadly, my first segmentation would be, is a company using AI addressing an operational efficiency within the healthcare system, or are they addressing a clinical need in the system with AI? And I guess from my perspective, if it's the first, you ought to show up to an investor with an example that works, if it's an operational efficiency and you can prove it, because that is something you can do by the time you reach an institutional investment inflection point. On the clinical side, we sort of see it as it follows really good evidence generation. You can see AI applied to algorithms on the clinical side. I'm personally a little skeptical that in the near term, you're gonna see an FDA-regulated product where AI is suddenly just improving whatever the FDA certified. I think that's kind of a future state where regulatory frameworks have to evolve for where technology can be accurately applied to cost savings and efficiency elsewhere in the healthcare system, particularly on the operational side. Megan, you probably have some opinions on that, I think.
Yeah, I may have a question for like both of you, which is I heard something the other day, which is that investors are going to believe that companies are going to need less capital because if they use Gen AI and all the machine learning and everything that we have available today, they're going to be able to build a company more quickly and with less capital. And so what it takes to build a digital health company now actually is going to require less capital than when you like founded your company, for example. And so I was curious, like, how do you think about that from a CEO running your company where the tech stack that you probably originally built, very different than what is required now? And from an investor standpoint, like, how are you factoring that in? And that isn't, I'm not talking about the startups that are selling algorithms as their business, but every startup right now is thinking about how do I use Gen AI capabilities to make my business more capital efficient.
And just to be clear, you're talking about the actual building of the company. Yeah. Well, I'll say, I don't think it's percolated its way through the heuristics that investors use on what capital a company needs. At this moment in time, given all the things we just talked about, the much bigger statement is you have to be lean and you have to be efficient with capital because it's hard to come by, and that's probably the lowest common denominator in the perspective. But I'll say organically, like I can't, over our 35 companies, I think about running a company 10 years ago and doing like marketing work, and now watching like some of our portfolio companies, Alicia included, teach me like how they're so much more efficiently doing the mundane tasks of like building a great company that are functional in nature. And so what we see is more of like a cross-pollination. Like if I see somebody developing amazing artwork and graphics for pennies instead of $50,000 with a brand agency, I'd put that CEO in touch with 5 others that are at that inflection point because they're doing that kind of thing. And that's sort of percolating around our portfolio actively.
Yeah, I think it's a really great point. It's a great question. Just to give you my perspective quickly. Most of my friends who are digital health founders now are getting a lot further, faster, which is actually good because right now, it used to be seed funding pre-seed funding was an idea. Seed funding was like maybe a little bit of revenue and certainly a product. And Series A was certainly like if you were at $1 million in ARR, you were like, definitely, that was great. And everything is increased now. Like now, pre-seed, you've got to have $500,000 you have to have a product and $500,000 in revenue. And then, seed funding, you've got to have, $1 million. And A is like, 3 million, maybe 5 million, or at least eyes toward it. And like that, that's not exact. Like there's certainly categories where that doesn't fit, but you have to go a lot farther with less. And so I think AI certainly helps with that. I'll say from our perspective as a growth stage company, we're actually now uniquely looking at a spot where we think that we can double our revenue without increasing our headcount. And it's not because, substantially. There will be certain roles like client success that we really need to continue to invest, but we are seeing so much more efficiency in other areas of the business that it's pretty impactful for us using AI internally.
I think, and what you just said about client success, I think is really important, because when you saw those incredibly high valuations, I think that there was this mistake that everybody was making of like, digital health companies as a category are going to have SaaS-like returns, and so we're going to value it as such. And the reality is that we know healthcare is messy and complicated and requires so much change management and sustained change management. And so what I hear from a lot of founders is like, we're actually, yes, of course we want to automate as much as we can, but we're never going to get rid of the services component of our business, because that's how we are sticky, that's how we earn trust. That's how we actually change behavior and care protocols and practices and all the things that we need to do with our clients. And that actually has to be sustained. And that requires a change on the part of investors, I think, to figure out, okay, what do the margins of this business actually look like if it's not pure SaaS? And we're actually allowing for more variation in these different types of companies, whether there's a device involved, whether it is just SaaS, whether it's, SaaS plus really embedded, tightly partnered services, because that's what the healthcare system needs from their partners to drive change.
Yeah, absolutely. All right, Alicia, we're talking about the future of funding. What is something that you wish every investor would know going forward for you about running a startup that would make them better partners?
I think,
keeping in mind that Ben is sitting right next to you.
I think Drew's trying to end the panel with some provocative debate. At least I'm going to close my ears. Go ahead.
Yeah, something that I wish that partners like Ben knew. No, just kidding. So yeah, like one of the things that we've seen in the last few years, right? And I'm just going to ask Ben a few questions, since he was an entrepreneur before becoming an investor, as he shared, is if you could give us an example of when did you last launch your first product?
We launched our first consumer product in 2012 and our first regulated healthcare product in 2016.
Okay. And when you built that product, where did you build it?
Well, one team, one roof, pretty much one big room. And,
all of you guys were together.
Yes,
going to the office every day.
Every day.
The traditional way of the past.
The traditional way of the past, yes.
So we closed around in 2020, and things dramatically changed. Even if you're building a physical product, right? In the early days for us, right, we were going with our masks, and fortunately all of us were in Cambridge, Massachusetts, so we can go and take the physical product to someone else's house. We had to basically build labs in their houses so that they could work, so that we could test and validate and continue moving the company forward. So I think one of the things is investors look a lot at patterns and like what has happened in the past to project the future and all of the data, but we are living in dramatically different times right now. And the way that the company is run is differently, the way that talent wants to work. Some of the things we really have to do hands-on together. Other things, everyone wants to work remote. Everyone wants more flexibility, right? And you want to hire the right talent that really cares about what you're building. And you want to also build a heart-healthy company, right? Like, we are all about heart health. So we think about all of these things into how we wrap all of the different areas and departments of our company. And for me, it's really important that we don't get compared to companies that have done things differently at different times, right? Like, we are living in really different times. We're also unlocking a new category in the cardiovascular industry, because for such a long time it's been universal. So for me, it's really important to kind of open to this new wave and how we can use AI, right? Like with our team, I think it's super important that we open new roles at the right time, right? Because in small teams, you need to have people wear many hats. The right tools, if you choose to have a subscription for some of these tools, Copilot, call it whatever, they can perform more than if you hire a new person that will need to ramp up. Or right now they're spread thin, you actually have to hire that person, right? So making all of these decisions, we're in a different time, right? Like I think it's super important to think about these different patterns and look at it in a different way. What do you think, Ben?
Well, so I agree with the facts that building a regulated medical product over the trailing 3 years was a fundamentally different endeavor than doing it 6 years ago or 12 years ago. And I do agree that you have to, as an investor or an entrepreneur, look at that moment in time. I would say if we look at one of our hosts' books, Gary Shapiro, the title is Pivot or Die. I actually do think, though, that is a universal truth and a heuristic for young technology companies, and I think you just gave a couple great examples of how you're doing it. That actually, I don't think has changed. I mean, yes, the circumstances of the last 3 or 4 years are obviously unique in history, but the companies that are going to survive that are going to use the age-old adage, pivot or die.
Yeah, and I'll just say that my best board members, just to validate, Alicia, what you were, I think, saying about Ben, my best board members are the ones with actual operational history, that have actually built companies first, whether it's founded or at least operated at a senior level in them. Makes a huge difference. Those who came straight out of finance, we had some different conversations sometimes. So wrapping up question, CES, we're here, it's all about the future and robots that clean swimming pools. So 10 years from now, we are going, let's just say that we're going to reconvene this panel. So without naming a specific company or anything like that, what is one area of digital health that you see you predict will have transformed the industry? And then what's one area of digital health that was completely overvalued and has totally bombed out? Megan, we'll start with you.
Oh, goodness. Is AI a category? Let's see. I think that if we do this well, I'm going to come back to the equity comment that I made at the top. I think that right now there is still a lot that is being built, which is built as intended, as you said, to serve the incentives that exist. But too few people have access to great care, and I think we are at a real rocky moment in terms of the degree of trust that consumers have in the healthcare system. So what I hope in 10 years is that we have been able to leverage this for good. And I don't really mind where the innovation is coming from, if it's coming from the small players or the big players or the incumbents or newcomers. But I do think that we need to figure out what is going to build trust with consumers, because right now they're actually willing to go outside of the system, experiment, use these direct-to-consumer companies. I was chatting with someone, they're like, we're seeing a rise in acupuncture and naturopathic medicine. People really want different sorts of solutions. And so I think if we do this well, we kind of reinstate trust in whatever that system looks like, and that it is really serving those people. So I know I kind of cheated. I didn't really say one thing, but I think that digital health really plays a role in creating that trust and access.
I love that. Yeah, that's great. All right, Ben, we got not much time left. Let's.
Okay, yeah, I'll make it fast. I think prediction. Looking out 10 years from now, all of the major tech companies are going to continue to invest in digital health infrastructure, but by virtue of their businesses, it's going to be largely horizontal, and that's going to leave a major opportunity to develop clinically specific care pathways for the home in chronic disease management, because nobody here, if you're ill, would prefer to be in a hospital than your home unless it's for something incredibly acute like a surgery or an emergency room triage. So I think there's going to be a great opportunity for companies that figure out that care pathway for a particular disease and build the right technology solution that will include sensors, data, in healthcare services. And I think something that, well, I won't go with the bomb because I want to give Alicia a chance to answer the question.
No, thank you. So prediction, I think women's health is human's health. We have done so much for male health so far, and it's changed the industry, and women's health will change the industry for both men and women. So I think if we do this right, where we're not doing like the pink tax, where we're putting pink on a razor and it's the same thing, but we're actually going deep into changing the way we provide care for women, it's going to be significant, the way that we improve quality of lives and the way that we build products in the future. And in terms of what's overhyped, I think a lot of services that we're seeing, right, similar to what I was saying about the pin tax, replicating things just with a different catchy phrase, we're going to see those fade out more.
That's great, awesome. Well, my prediction is that CES is going to be the place to see those futures. So
Agreed.
please keep coming back.
See you guys next year.
Yeah, and thank you all for joining us in this panel. Please join me in thanking my panelists. Yeah, I look forward to talking soon.